Have you ever considered how the guarantees designed to protect our savings can sometimes collapse under immense pressure, leaving financial systems vulnerable? The Federal Savings and Loan Insurance Corporation, commonly known as FSLIC, failed during the savings and loan crisis primarily because it was critically underfunded and structurally ill-equipped to manage the overwhelming wave of losses from insolvent thrift institutions. This crisis demonstrated the critical importance of robust and adaptable financial safeguards. The core mechanism behind FSLIC's failure involved a dangerous combination of factors. Savings and loan institutions, or thrifts, were historically designed to provide mortgages using deposits from local communities. However, deregulation in the early 1980s allowed these thrifts to engage in riskier investments, moving beyond their traditional housing finance role. Simultaneously, rising interest rates meant thrifts were paying more on deposits than they were earning on their existing, long-term, fixed-rate mortgages, creating an immediate profitability crunch. These speculative investments often went sour, and the underlying financial structure was simply not designed to absorb such widespread losses, especially as FSLIC's premium income, collected from the thrifts themselves, proved woefully inadequate to cover the mounting liabilities. Understanding this historical failure means recognizing the vital role of sound regulation and sufficient capital for deposit insurance systems. When an insurance fund is unable to accurately assess and cover the risks it underwrites, it becomes a point of vulnerability rather than a source of stability. This situation serves as a powerful historical lesson in the consequences of misaligned incentives, inadequate oversight, and an insurance fund that was essentially bankrupt before the full extent of the crisis was even acknowledged, forcing the United States government to step in with substantial taxpayer-funded bailouts. A key insider detail is the concept of regulatory forbearance. Instead of promptly closing insolvent thrifts, regulators sometimes allowed them to continue operating in the hope they might recover, a practice known as zombie institutions. This strategy often worsened the problem, as these failing institutions took on even greater risks, thereby inflating FSLIC's ultimate cleanup costs. This period also highlighted the moral hazard inherent in deposit insurance without strict oversight, where insured institutions take on excessive risk because depositors are protected. Ultimately, the FSLIC's collapse underscores the enduring importance of prudential regulation and correctly capitalized financial safety nets. The experience led directly to the creation of the Resolution Trust Corporation, or RTC, to manage and sell the assets of failed thrifts, and ultimately to the restructuring of the entire deposit insurance framework under the Federal Deposit Insurance Corporation, or FDIC. This historical lesson shows us that robust financial oversight and adequately funded insurance schemes are not just bureaucratic necessities, but essential pillars for maintaining confidence and stability in the wider economy.